All right. First of all, let me introduce myself. My name is Gil Mariscal, and I actually am an SVP of capital markets, and my specialty is in non-QM lending. So we have a very, very long-standing relationship with Chris Lopez, with Yessi, David Tran, a lot of people in your office, and you guys are one of our preferred lending partners when it comes to non-QM lending. So I just wanted to really take an opportunity to give you a broad overview of one of our specific products, which is the bank statement loan. It seems to be one of the most popular products that we have available in the market today. And the reason why it's so popular, it's because it's very, very flexible and it allows a lot of self-employed individuals to qualify a loan wherein they're not able to qualify for on their own with traditional income documentation like tax returns and things like that. So, first of all, we offer two different types of products. We have a 12-month bank statement loan and a 3-month bank statement loan program that we've put together along with iCore that we offer to the general public. Basically, in order for a borrower to be able to go into a self-employed bank statement loan program, at least one of the borrowers has to be self-employed. So if you have a husband and wife that are applying for a mortgage loan and they are applying for it jointly, one of the borrowers must have a history of being self-employed for at least 2 years. The other individual may be a wage earner, so they could have a normal 9 to 5 job, hourly salary, however they may get paid. And what we do is we blend and combine the incomes. So you can have a W-2 borrower that is a wage earner that is on a fixed income, along with a self-employed borrower. And what we do is we calculate their incomes separately. So the W-2 wage earner, we calculate their income just like what we would any other traditional income using the Fannie Mae SAM worksheet. Whether it be hourly, whether they get overtime, whether they get bonuses, however it may be, we calculate their income the same exact way as you would on a traditional type of loan. When it comes to the self-employed individuals, we will ask for 12 months bank statements. And then what we do is we go through those bank statements. If it happens to be an individual that is a sole proprietor and they're making a huge mistake and putting all of their income in the same exact bank statement as their spouse because they share a bank account, that normally presents a little bit of a challenge to an underwriter because it does not allow me to clearly show what income belongs to the self-employed individual and what income belongs to the wage earner. So what we do is we kind of have to, throw on our underwriting hat to kind of look and analyze the bank statement very, very closely. Anytime that there's direct deposits, we back out those direct deposits. If we see anything coming in from Zelle, PayPal, Venmo, or anything else like that, normally you could tell who that is being sent to. So if we show PayPal's, Venmos, and Zelles that are coming in addressed to the wife and she's the wage earner, we will back those out. Those will not count. Any other deposits that are hitting the account that we see, we will count those as normal business deposits for the borrower that is self-employed. That's normally not the best way for us to be able to do a loan. We normally like it when self-employed people keep a separate bank account. The reason why that's so important is because when it comes to their tax filings, in the event that they ever get audited by the IRS, their wife could get in trouble because they're commingling all their money, and good luck explaining to the IRS that it's not business income that they failed to report because they're mixing up all of their finances. That's why normally it's a very good idea for business people to keep completely segregated bank accounts when it comes to their business so that the only money that touches that account is business revenue. The only money that comes out of that account are true business expenses. And the money that's left over are the profits of the company. That is, an ideal way to doing bank statements. But the good thing is We don't shy away from the tough ones. We try to figure out a way to get them done. But ideally, that is the situation you want to be dealing with. When we have someone that is self-employed, we never ever ask for tax returns. We'll never ask you for any type of 4506T or anything to be signed for the person that we're doing a bank statement loan on. However, if they're blending their income together with their spouse and their spouse is a W-2 employee, then we will validate the W-2s just like you would any other full doc loan. Okay. So some of the restrictions that we have on bank statement loans is that at least one of the borrowers must be self-employed. One of the things we do often run into when the borrowers are using their personal bank account in order to do business is we see other individuals' names pop up on their bank account for some reason or the other. We follow the direct relative rule when it comes to Fannie Mae. So if it's like a son, a daughter, a spouse, a mother, a father, things like that, and they just have them on there in the event of an emergency, we're okay with that. We do look very closely at the deposits to make sure that no one else's money is hitting that account. If they just have them on there in the event of an emergency, we're perfectly okay with that. What we would ask for is a letter of explanation to explain exactly why that other individual's on the bank account. In addition to that, 100% access letter and any deposits that we see that are coming in the name of that other individual that is also on the bank statement will be excluded. We will pull it out. We do require a minimum of a 600 FICO score to do a bank statement loan. 12 months bank statements, we allow you to go all the way up to 50% debt to income ratio. And if your loan's at 80% or below LTV, and the borrower has good credit, which means 660 plus FICO scores, and they're graded an A plus, and the loan is a full doc loan with 2 years W-2s or 2 years tax returns, we allow you to go all the way up to 55% debt to income ratio, as long as they have 6 months reserves. Self-employed 12-month bank statement loan. So
Hey, Gil,
yes,
are you sharing your screen?
I am.
Okay.
Why, can you not see it?
I can't see it on one side, so just is everybody or just me?
I can't see the screen.
The PowerPoint. Okay.
There you
There
go.
it is.
Now we can see it.
Now we can.
There you go, boss.
Huh.
Now
I've
we
been
can see it.
I've been sharing it the whole time.
Okay, there we go. Now we see it.
Yeah, for the record, there was nothing to see. So all I had before was just the restrictions and stuff like that. So there was like really nothing to see. So self-employed borrowers, anyone that owns 25% or more of a corporation, an LLC, or a business in general is considered to be a self-employed borrower. We do verify the existence of the business either via a business license from the city, articles of incorporation from the state in which they do business in. We will also ask you for an operating agreement if the company is an LLC, or corporate bylaws if it is a corporation. And we will actually independently pull the annual reports that shows exactly who the officers or the members are for that exact corporation or the LLC in order for us to determine eligibility. So a business that functions as a nonprofit organization, you're not able to do, because a nonprofit basically doesn't file any tax returns. A nonprofit, you can't touch any of the bank statements because only a board of directors that has been assigned to the nonprofit could direct how the nonprofit's money could be used. So nonprofit could never, ever be used for qualifying purposes, nor the assets of a nonprofit could ever be used for the purchase of real estate, as far as under the guidelines that we have. I don't know of any company that allows a non-for-profit organization to buy any type of real estate or qualify with nonprofit bank statements, only because of the rules that the IRS has that governs the nonprofits. A unique thing that you have the ability to do is for people that are service and tip industry related employees like waiters, waitresses, bartenders. people that work, for example, in Las Vegas nightlife, such as club hostesses and things like that. You're able to use the tip income that they earn above and beyond the base salary, and that we verify via pay stubs and W-2s. So if these people are making $36,000 a year, earning W-2 income, getting paid hourly, minimum wage or however they get paid, normally only 10% of their incomes get reported to the IRS. But if their income is a lot higher than that, because they earn a lot of tip income, then what you're able to do is get 12 months bank statements. And we go through the bank statements and we look at all the cash deposits that are coming into the bank statement. We also look for Zelle transfers, Venmo, PayPal, or any other type of electronic payment system that may be used. Because a lot of times when you're tipping people out, the one that has all the cash, they just say, okay, I got, $360 in cash. Some of the tips were made directly through the cash register because they paid with credit cards. So I'm going to split my tips with you. And then what they do is they Venmo or they Zelle or whatever their portion of the tip to the bus boys and things like that. So it's not common for us to see that, and we're perfectly fine with that. Another thing that has recently popped up that's become pretty popular here in the last couple of years is things like OnlyFans. We do loans for entertainers that are on OnlyFans. We qualify them just like we would any other bank statement loan. So whether they be adult entertainers, meaning strippers, whatever it may be, musicians, club hostesses, waiters, waitresses, bartenders, anyone that's involved in a cash type of business, we are able to give them credit for that additional income without having to provide a business license. All we do is ask for a business reference letter that basically states, yeah, they're a waitress, they earn tip income, not all their income is reported, and then we're perfectly fine with that. We also allow ADU income. So when it comes to a refinance, if the bar has a history of renting out an accessory dwelling that they have that's located on their property, we just ask for a copy of the lease agreement and 2 months worth of bank statements to prove that they're collecting that amount of money in rent, and they will get credited for the income that is derived from the ADU. On a purchase, we do not allow that, only because the bar does not have a history of collecting that additional ADU income. Rental property income, this gets a little tricky when it gets to bank statements. When it gets to a bank statement loan. And the reason why it does is because a lot of people are saying, I'm a professional property manager. I own like 8 properties. I own 3 to 4 unit properties on apartment buildings, whatever it may be. And all of my deposits are coming from rents. The problem that you normally run into when it comes to that is that, okay, well, you can't use 100% of those deposits as income, because we already know expenses are going to go back out towards paying property taxes, towards paying homeowners insurance, even if the property is free and clear. They're also going to have vacancy. In addition to that, they're also going to have maintenance costs. Now, a lot of loan officers call us all the time and they argue and they say, no, that's their income. That's their only source of income. Look at all those deposits. They're depositing 100 grand. But then when you're looking through their bank statements, their ending balance is maybe $6,000, because $94,000 is going back out, because they're forgetting one important thing. A lot of these properties have a mortgage. So when they're paying out PITI expenses, and then you have to factor in occupancy, and you have to factor in operational expenses for the actual real estate that they own, the amount of income that's left over is not a whole lot. And so we have to keep that in mind when you're trying to use a professional property manager who claims that their only source of income is through rental property income. You have to take into account all of their expenses. So the borrower must attest that the rental income is their only source of revenue, that is the only money that's hitting their bank account. We ask for 12 months bank statements showing proof of receipt of all of the rental income. We want to make sure that it's not being commingled or mixed together with child support or something else. And the deposits have to support the amount that is listed on the lease agreements that were provided, because we will ask for lease agreements. So if they're giving you a bunch of lease agreements, and when you add up the total on all the lease agreements, it totals up to $100,000, but we only see 60,000 going into the bank and deposits, we're going to start asking a lot of questions. We're going to say, why the heck is $100,000 not being deposited? And the bar may be disqualified for that, because they may be trying to fluff up their books to show that they're getting additional rental income just to qualify, when they're really not earning that rental income. So you have to be very, very careful when it comes to that, because we do verify all of that. We ask for a very detailed schedule of real estate that's owned. It has to be completed for all of the investment properties that the bar personally owns. All the PITI information must be listed so that we can calculate that towards the debt to income ratio. And then, like I mentioned before, we need a copy of all the fully executed lease agreements, rental agreements for all the properties that they own that they're trying to use for the transaction. And we will only take 75% of that lease amount, due to the fact that you have to have an occupancy or vacancy ratio. If the above documentation is provided and the income, basically, once we do all of the calculations, whatever income is left over, then that is the borrower's net income once all this stuff is backed out. So if the borrower has a wage earner job and the rental income is just an additional source of income, then we will basically use the traditional method of using the bank statement calculations. And then we will just back out the mortgage payments, the expenses, and the expense factor when it comes into calculating their net income on a bank statement. Personal bank statements, we have 3 types of bank statements, or what we consider bank statements. Personal bank statements, where it's just the name of the personal individual. They're doing business under their name. They don't have a DBA. They do not have any corporation. They don't have an LLC. And they're saying, this is my personal bank account. When it comes to me using my personal bank statement, I derive income using a completely separate account. So the income that's hitting my personal bank account is my take-home pay. What we do in that case is we'll ask for a couple of months worth of the business account that they claim that they have, that shows that the money has been separated. So when they have segregated bank accounts for a corporation and they're taking home consistently 15,000, 20,000, and we see those transfers from the business to their personal, then the borrower can get credit for up to 100% of all of the deposits that are going into their personal bank account. The reason we give them credit for 100% is because all of the expenses have already been taken out of the business. The money that's hitting their personal is their take-home pay, or at least we consider it to be that. We'll take 12 months bank statements.
Yeah.
We will look at the deposits. We will add up all of the deposits and just divide it by 12. And then that becomes their personal bank statement income that we're using for qualification purposes. We do look for patterns of deposits, and they have to be very, very consistent. So when I know a lot of you guys try to do loans for realtors, real estate agents are the most difficult people to do loans for. The reason why is because their income is not consistent. They are 100% commission. They do not get paid unless they've sold the property. And some real estate agents take on real estate activity only as a part-time job. So they may only sell one piece of real estate every 3 months. So you may only see like 4 to 5 deposits per year. For someone that has inconsistent income like that, an underwriter will scrutinize that income heavily, and they'll basically say that their income is inconsistent and it cannot be used. They like to see people that have consistent deposits, because when they have business expenses or living expenses that come up, They may not have the ability to have that revenue at their availability to be able to use to make their normal mortgage payments, to make their car payments, to live off of. And that's due to the fact that they're relying on the sale of a piece of real estate for them to derive their livelihood. We do them, but some real estate agents that we see, they also have a full-time wage earner job, and a lot of them are weekend warriors. So they'll sell real estate on the side, either in the evening or they do it on the weekends. And then they have a full-time job, whether it be as a plumber or whatever it may be. And then what we're able to do in that case is we're able to blend all of their incomes together to assist them and help them qualify. We look at deposits that come in, whether they be ATM deposits, bank teller deposits, PayPal deposits, Venmo, things like that. A lot of people in today's economy that are self-employed, maybe they don't have the credit, they don't have the business experience to walk into Chase or Wells Fargo and say, I need to set up a merchant account to be able to accept Visa, MasterCard, American Express, Discover cards, and things like that. So they rely on other very business-friendly type of companies to allow them to process credit cards or electronic payments. A lot of them use Square, which is that little dongle that you add to your iPhone and you can just swipe a credit card. When they have like little businesses, like in the swap meet, they have, a small little stand there on the weekends that they sell stuff at, or farmers markets, things like that. They use PayPal, they use Venmo, they use Zelle, they use all these other alternative payment systems to be able to accept electronic payments from the general public. So before we used to scrutinize PayPal and things like that, but now it's become a normal payment processing system. They're very easy to use and they allow you to accept credit cards without having to go through this entire background check and do all this other stuff that normal traditional FDIC banks force consumers to go through when they are trying to accept different types of payment platforms. We do look for, when it comes to bank statement loans, we look for the people to be able to provide us proof of self-employment. So whether it be a letter from their CPA, a business license from the city, from the county, from the state, if they're a corporation, if they're an LLC, however it may be, they have to document proof of self-employment. And the reason we have to get that is because we have to make sure that we are making 100% sure that the business revenue is being reported to the IRS. If someone's trying to evade taxes and they're not reporting stuff to the Internal Revenue Service or to the state of California, and they're not functioning as a true business, and they're trying to stay off the radar without having any type of business license or paying local or state tax, whatever it may be, then we won't be able to do a loan for them. And in fact, we are required to file a SAR against that individual if we suspect that they're trying to dodge, authorities or the tax revenue departments. So that is the reason why they ask for proof of self-employment, to make sure that an accountant can basically state that that individual is filing as a self-employed individual, whether it be a Schedule C, a Schedule E, whatever it may be, and that all of the income is actually being reported to the tax authorities. Alternative, when it comes to a commingled bank statement, that means that the bar is using their personal bank account as a business account. That's what I said earlier on is not a very good idea. But we accept it. We know some people just don't have the knowledge or the know-how to go out and set up a corporation or file a DBA and things like that. So we just take it for what it's worth. And what an underwriter does is they kind of look at the type of business that the borrower is in. We have what's called an expense factor that we use based on the type of business that the borrower does. And we kind of determine based on the number of employees, whether or not they have to carry inventory, the type of business function that there is, or that they're in, to determine the amount of income that they're going to get credit for. So one of the things that we look at is the number of full-time employees that they have. If they have between 0 and 1 employee, in other words, the only employee is them, then they're going to have very, very little overhead. If they have between 2 and 10 employees, then they're going to have significant overhead because now you got to pay into FICA tax, Social Security, Medicare, state income tax, state disability insurance. You have to pay, the IRS, file quarterly returns, and do all kinds of additional stuff. Normally, someone that has 2 to 10 employees or contractors also has to have a physical location. And based on the type of business that they run, that determines the amount of expenses that they may have. So if it's a service related business, like the bar says, well, I'm an accountant, I'm a consultant, I'm a counselor. So maybe they have a psychology degree and they have a little office where they see patients and they're providing some type of family counseling or mental health counseling, then their expenses may be very, very low. If they're independent financial planners, if they own an insurance company, if they're an attorney that's self-employed and it's just them and a little paralegal that they employ, if it's a therapist that maybe does physical therapy, all of those are very, very low expense factor types of businesses. So if it's just them and it's a one-man show, we will only hit them with a 20% expense factor. If they have 2 to 10 employees, the expense factor goes up to 40%. If they have more than 10 employees, it goes all the way up to 60%. If it's a product type of business where they're selling like clothing, jewelry, they're in construction, food, service types of restaurants, manufacturing, maybe they have a trucking company, a retail company where they're selling little trinkets and things like that, the expenses are going to be higher. The reason why is because when it comes, for example, to construction, a lot of people are like, oh, they're providing a service. Well, not really. They're selling a product because they're building something. So if you're building a porch in your backyard, the person that's doing the work is having to come in and bring in, people that are going to lay down rebar, people that are going to do all the framing, people that are going to bring in the concrete, people that are going to stamp your concrete, people that are going to put up the posts, whatever it may be, they're having to buy materials. Since they're having to buy materials, that is considered to be inventory. And because of that, the type of business like that is more expensive to run. Truckers that are independent contractors and owner operators, trucks are very, very expensive to run. You got a big truck payment on a semi truck. You got to pay for a trailer. Now you got to pay for the wear and tear, the maintenance, the diesel fuel. You guys have seen how expensive diesel is nowadays. The insurance, all of those things. A trucker, just because he's a one-man show doesn't mean it's 100% profit. They have to have basic operating expenses. And that's why even if you're an owner operator, your expenses are going to be about 10% higher than if you're providing a service, because your truck is your inventory. You are providing and selling a product, which is you're moving a product from point A to point B. So therefore your expenses are going to be higher than a normal individual. Real estate businesses, they're very expensive to run. When you're a developer or a flipper or anything else like that, your expenses are going to be very, very high. We get a lot of bank statement loans and like, oh, this guy's a professional real estate guy, he's a flipper. And then we get, loan officers that are upset saying, why did you cut their income? You're not giving them credit for all their income. And I'm like, well, I see these deposits that are coming in for 700,000, 400,000, 300,000. That's because they're flipping properties. But what the loan officer is not taking into account is how much did they pay to acquire the property? How much did they pay in closing costs to buy that property? How much are they paying to rehab the property, for the building materials, for the labor, for everything else? Now you got to sell the property. You got to pay real estate fees. I don't care. Even if you're a realtor, you're still paying real estate fees because you got to have another realtor that's normally involved in the transaction. In addition to that, you have carrying costs, because if you took out a hard money loan for that, unless you paid for the property in cash, you have carrying costs for interest and things like that for the cost of the money that you used. And then once you sell the property, you have to back out, all of those costs to see what the net income was after the property was flipped. And they're not taking that stuff into account. So what we try to do is we try to simplify things. We try to make it very, very simple. So if you have an individual that's doing this on their own, we said we will hit them with a 70% expense factor. So you don't have to provide final settlement statements from the purchase, a final settlement statement from when the property was sold, receipts for all the materials that were purchased to do the rehab of the property, calculations and mortgage statements for the carrying cost to calculate the cost of the money and the hard money and all that other stuff. All of that stuff becomes a nightmare for the borrowers to provide. So for that reason, we devised a different way to account for the expenses for a real estate related type of business. So if you're a one-man show, the expense factor is 70%. If you have multiple investors and you're all in it in a cooperative with an LLC, you get credit, you get hit with up to 75% in expenses. And you have more than 10 people, which is very, very rare, then it's 80% expense factor when it comes to property flippers and things like that. Does anybody have any questions so far? Did you mute people?
Hi, I have a question real quick.
Okay, cool.
So let's say, you add all the deposits back out, whatever does not pertain to the self-employed customer,
Uh-huh.
and then you give them 100% of those deposits, or do you take 50% off of that, or it just depends on your expense, their position, their role, what they're doing?
When it comes to a business bank statement loan, we normally ask you what type of business does the borrower run? How many employees do they have? Based on the answers that the borrower gives you, we determine a fixed expense factor. So if they're saying, oh, I'm a consultant, I'm a business consultant, I have an MBA, I go in and help struggling businesses to reorganize, make them more efficient, and then I collect a fee. Or I'm an independent IT consultant. I provide, cybersecurity protection for a lot of different companies. I work remote. I work for my home office. I just maintain their networks, make sure that they're patched up, secure, things like that. And I collect a fee from every single client every single month. Instead of them employing someone full time, they pay me as a consultant and it saves them a ton of money. So if you have a type of business like that and you explain it to us, then we're going to say, okay, that individual is a consultant. So he's running a service-based business. He's working from home. So therefore he has no overhead. In other words, his only expenses may be paper and things like that, maybe paying some utilities, his cell phone. So his expenses are going to be very, very low. So since he's a one-man show, the number of employees are going to be between 0 and 1, which is just himself or maybe a little assistant. And since it's a service type of business, his expenses are only going to be 20%. So if he's depositing $100,000 a month, we're going to back out 20 grand for expenses and he gets credit for the other 80,000 bucks. So we add up the bank statements over the period of the entire year for 12 months. And we hit him with 20% in expenses and he gets credit for 80% of the deposits. Does that make sense?
Yes, thank you so much.
Sure.
Appreciate it.
Sure, my pleasure. Any other questions? Okay, I see a bunch of group chats. I guess you guys couldn't see my screen. Sorry about that. Okay, so in the event that you're saying, well, those expenses are too high, the bar is saying that their profits are a lot higher. They don't have that much in expenses. You could, instead of using this, what I showed you on the previous screen, which was a fixed expense factor, which is one of these here, you always have the ability to get a letter from the borrower's tax professional. And their tax professional could say their expenses are not 40%. This guy runs a very lean operation. He only uses independent contractors when he needs some additional help. So it's not like he's paying them full time. So therefore, his expenses are a lot lower. His expenses are only, for example, 15%. So if you have their tax professional who is licensed and in order to practice with the IRS and file people's tax returns, and they give you a letter, we will use whatever expense factor is on that letter. So instead of using our assumed, what we call an assumed expense factor, we will use the actual expense factor that their accountant gave you. We have no problem in doing that. So all you have to do is to get that tax professional to write a letter on their letterhead. They sign it. They put their license where we could verify that with the state or with the IRS. They could be a CTEC, which is, a professional tax preparer in the state of California. They could be a P10, which is a person that's licensed to do federal income tax returns to practice with IRS, enrolled agents. It could be a CPA. It could be any of those. As long as they're licensed to practice with the IRS and file and touch people's tax returns, we will accept a letter from them. So keep that in mind when it comes to my expenses are too high. I don't have enough income to qualify. And the bar says that their expenses are a lot lower. We have no problem accepting a letter from an accountant that says that their expenses are lower. As long as the bar is able to provide that, we will use it. We have no issues with that. Another way that you could rebut the fact that maybe the expense factor is too high, you're trying to get it lower, is the bar could always provide a profit and loss statement. So if they provide a P&L and it's signed by their tax professional, we will use the net operating income that's on that profit and loss statement in order to qualify the borrower. Just like you would anyone that's full doc, we could use the P&L in order to be able to determine what the net operating income is for the year. You take that net operating income divided by 12, and that's the income that goes on the 1003. So you have to be very, very careful when it comes to a bank statement loan, though, because whatever income you put on the 1003, that income could only be adjusted downwards. So in other words, it could only go down. It could never go up. So if you put that the bar makes 10 grand a month on a bank statement loan, and all of a sudden you run into a debt to income ratio problem, and you're saying, no, they really make 15,000. Once that loan is disclosed, you cannot go back and fix it. It's too late. The only way that you would ever be able to make that adjustment is if the loan starts over. You would have to start the loan process all over again, cancel the previous loan, and then redisclose that loan from scratch like it's a brand new loan. And the reason why that is because under Dodd-Frank, we still have to document the borrower's ability to repay. And the way that they determine that the borrower has the ability to repay on an alternative income documentation loan is that they look at the 1003. And the 1003, whatever income is on there, it cannot be adjusted upwards because you can't validate or verify why it went up. On a wage earner, you could do that because you have paycheck stubs, you have W-2s, you have tax returns, you ask for tax transcripts, you could get written verifications of employment. You could pull the work number. You could do so many different things to justify and explain why their income is higher because they got overtime, they got bonus, they got commissions, they got all these different things. But when it comes to a self-employed individual, you could never explain or justify why their income went from 10 to 15 grand overnight and why you bumped up their income. Because you already had those 12 months bank statements, you'd already done the calculations. So why didn't you come up with that higher number to begin with? And that's the questions that they ask when the loans get reviewed by what's called a TPR firm. That's called the third party verification firm. That third party review company, the TPR company, is somebody that issues a rating to the mortgage loan that's been written. And in order to sell a bank statement loan, Ruben has to send it out to be rated. It has to be rated. They normally want A's across the board. They like to buy straight A students. If you're messing with 1003s, changing income, and the file is very sloppy, it'll get graded less than an A. Anything less than an A, the loan becomes worthless. No one wants to buy it because they're saying there's something wrong with compliance, there's something wrong with income, or there's something wrong with that loan. And a lot of investors will shy away from it. That's why when you're doing a non-QM loan, it has to be submitted perfectly. because if anything changes in the process, it could throw the whole loan for an entire loop. And so you have to be very, very careful when it comes to documenting a bank statement loan. You also have to have that honest conversation with your borrowers. Your borrowers have to disclose everything. So if they're telling you that they own 100% of a corporation, and then you go, or we, or Ruben, or anybody in your office pull stuff from the Secretary of State's office, and we find out that there's a CEO, a CFO, a president, director this, director that, and it's all listed on the annual reports that are filed with the state. No one's going to believe that this guy owns 100% of the company unless you provide federal income tax returns that shows us a K-1. The reason why is because why would you list 5 other officers? Normally officers are shareholders or owners. Not 100% of the time, but normally an underwriter will assume that they own it because they're also being listed on public records. Why else would you go on public records if you did not own the company? The state of California, no other state, forces you to list more than one officer. And that one officer, if you are 100% owner, it should only be you. So why are you listing all these other people? Oh, that's my brother. Oh, that's my cousin. Why are you listing them all on there unless they own a piece of the company? And so now you're going to run into an uphill battle where you're going to have to prove and document that this person owns 100% of this company, because they're going to say, well, why is something different being reported to the tax authorities? And because what gets reported to the state of California, for example, with the Secretary of State's office, that gets reported to the Franchise Tax Board, to the state of California. And now the state of California is going to be looking for a self-employed tax return that's going to come from all those people that are listed as officers. They're going to be looking for K-1s. They're going to be looking for additional revenue that they could collect money on, because the Secretary of State shares that information with taxing authorities. So just be aware of that. Make sure the bars are always telling you the truth, because if you're halfway through a loan and we catch the borrower in a lie, that's considered to be a misrepresentation, and it's considered to be loan fraud because they're trying to lie in order to get a loan. And then you may be stuck where the loan may be declined, suspended, or now you have an underwriter that's going to be on guard throughout the rest of the process, all because the bar didn't tell you the truth. And it could be something super easy that could have been overcome had they fully disclosed it. But keep in mind that underwriters do not like surprises. They don't like to be surprised. So you have to be very, very careful when it comes to doing alternative income documentation loans. The same thing goes when you're doing a full doc loan. If the bar says, oh yeah, that's my income, that's this, that, and then we get a written verification of employment, it doesn't match what's on the W-2s. It doesn't match their year-to-date pay stubs. And and you were counting on all that income, and in order to qualify, it puts you in a bad situation where now they may say this guy's lying. And that's the last thing you want to hear when you're doing a mortgage loan. So besides that 12-month bank statement loan program, you also have the ability to do a 3-month bank statement program.
Hey,
But this one,
before you jump into that, just a quick question, because I don't
Sure.
want to far from where you were.
sure.
What if I have a self-employed client that reports his own, he files his own taxes, he doesn't have a CPA? Will you allow the borrower to take it down to a CPA, his last few years tax returns, and generate a CPA letter, or is my borrower kind of dead out of the water because he files his own taxes?
You could do that. There, if he takes his tax returns to a tax professional and says, look, I need a letter that states that I've been filing a Schedule C for the last 2 years, that I've been self-employed for at least 2 years, and that tax pro is just going to write that letter for like $300 or something, there's nothing wrong with that,
Okay,
because they just verified self-employment. They looked at their last 2 years tax filings. We don't have those taxes, so we couldn't tell. But a tax pro did look at them, and they could write that too, saying I don't prepare them, but I did review them, and I can note that they were filed with the IRS, and he does file a Schedule C for the last 2 years.
perfect.
As long as they say that, you're perfectly fine.
Perfect. One more question. Is there, depending on the business, I know you said there's certain expense ratios, and if we have a CPA letter, is there a minimum expense ratio that you guys will allow? Because what if my CPA says I have a 10% expense ratio? Will you accept that 10%, or is there a threshold that you will go
Once
below?
you go below 15, they start questioning stuff. So you just
Okay.
have to be careful with that.
Sure, and we have to be ready to document if it does get questioned, if it's under 15%.
Correct.
Okay, thank you very much, Gil.
Sure. Any other questions? Cool. Okay. So the 3-month bank statement program. Basically what it is, it's a P&L program. If you could get a tax professional that does a profit and loss statement for the last 12 months for the borrower, and you provide 3 months bank statements that support that P&L, that's the only income documentation you need to be able to qualify for a bank statement loan. What I mean by that is, let's say you get a P&L and it says that this borrower generated $1.2 million last year in the last 12 months in business revenue and sales. Their net operating income is $300,000. So what that means is that the $300,000 in net operating income, that becomes their profit. And that's what you're going to use to qualify them, which is like $25,000 a month. What we do is we ask for 3 months bank statements that supports the P&L. What we look at on those bank statements is if you take that $1.2 million that they claim they made on their profit and loss statement in the last year, and you divide it by 12, that's an average of about $100,000 a month in revenue that the company should be showing on their bank statements. So when we look on their bank statements, we see 1 month they deposited $85,000. Another month they deposited $105,000. And then the third month they deposited $92,000. You add up those 3 months, which was the $85,000, you add up the $105,000, and then you add up the $92,000. That's equal to $282,000 divided by 3. That is only averaging $94,000 a month in deposits, while the P&L claims that they were making $100,000 a month. We're still okay with that because we will give them a 10% variance. So as long as they're within 10% of the average deposits that we calculated, the borrower will get approved for a 3-month P&L only program because their average deposits are $94,000 a month based on the scenario that I just went over. So because of that, that loan would be approved. So all you have to do is tell the account or tell the borrower, get me a P&L. For example, we're in the month of July right now. The last month that ended was June. So you go back and you say, I need a profit and loss statement from July 1st of 2022, ending on June 30th of 2023. And that is exactly 12 months. So based on all of the deposits that came in, all of their expenses, their net operating income is what we use for their actual income. And we ask you for 3 months bank statements that support the average deposits within that time period. So the bank statements have to start from the very last month of the P&L. So if the P&L ended on June 30th, you're going to need to get me June, May, and April of 2023 bank statements. We add up the deposits for those 3 months. We don't back anything out. We're only going to look at the gross deposits. Based on those gross deposits for those 3 months, we look at what the P&L says they generated in the last 12. We take the gross sales from the last 12 months, you divide it by 12, and that tells you exactly how much money they made gross per month. And that's what we look for on those bank statements. As long as you're within 10% of that average, the loan will get approved. You do not need an expense factor letter. We no longer hit them with an expense factor because the profit and loss already took into account all of the expenses for the business. But there are a couple of rules that need to be followed. Number one, the person that prepared the P&L, which is the accountant, they have to sign the profit and loss statement. They also have to give us a letter that states that they prepared the P&L on behalf of the borrower, and those are the true and accurate numbers for the last 12 months of revenue. At the same time, they could state that the borrower's been self-employed for 2 years, whatever it may be, and then that way you could kill a lot of conditions off with just one quick letter. But what we do double check is that there hasn't been any NSFs or any overdrafts on any of those bank statements in the last those 3 months bank statements that they provided you. NSFs are a big thing. Same thing with overdrafts. When you're doing a bank statement loan, please consider the fact that the borrower was unable to give you tax returns because they probably show very little money to the IRS on their tax return. So they can't give you tax returns to fully verify their income. Now they want you to believe that their income is what's going into their bank statements. All of a sudden you're going through their bank statements and you see that they're bouncing checks left and right, that their account is ending in negative balances. They're having all these difficulties maintaining their books. So when that happens, we only have a certain tolerance of 3 months. 3 times are they allowed to have an NSF in the last 12 months. And those NSFs, anything that's considered to be an overdraft, where the account was overdrawn or a check bounced, they're considered to be one and the same. The only time we don't count an overdraft is if the borrower had overdraft protection. So if they had a savings account, a credit card, or something else that was tied to their business account, and the account didn't really become overdrawn because they tapped into their savings and moved money over automatically with overdraft protection, in those cases, they're going to ask for a letter of explanation to say, why did it become overdrawn? And the bar says, well, I have an account set up just for that. In the event that my bookkeeper or my accountant cuts a check and he didn't give me enough time to make deposits, I have money in savings that covers that. And I never bounced a check. I never overdrew my account. I just moved money from savings over. If they do something like that, we will be okay with it. But if they're bouncing checks, then that becomes a little bit of a problem. And so you have to be on the lookout for that. Another cool thing about the bank statement programs, as far as the way we structure them for I-Corps, is we know that a lot of borrowers are in some cash heavy businesses like convenience store owners, gas station owners, restaurant owners, businesses that actually handle a lot of cash. For those types of businesses that handle a lot of cash, it's normally very difficult for you to be able to source it. So when you're looking at a bank statement and it says cash deposit, cash deposit, cash deposit, you're seeing all these deposits. A lot of lenders say, well, you can't source cash, so they back it out. For us, as long as it's a normal part of their business and it's part of their business model where they handle cash, a convenience store owner or a liquor store owner can't help that somebody goes in there and buys a Coke and gives them a $5 bill. You go and put gas, can you please put $20 on pump number 1 or $50 on pump number 2? Those people handle cash all the time. So why would they be penalized for being in a cash business and saying, well, I can't count any of your cash deposits because you bundle them all together and, every 3 days, you take the money that's in your safe and you go to the bank and you deposit all that cash. As long as they deposit it, it's a deposit. They're not trying to hide anything from the IRS. They're depositing in their bank account, so the bank is reporting it. If there was anything suspicious with that money, let the bank deal with it. They would be the ones that are reporting it. But the banks could see a pattern because that's their client. And they know the type of business that they're in. And in fact, they're being charged a convenience charge for depositing large amounts of cash. And the reason why banks charge you for cash deposits is because now they're required to report crap to the IRS. And so since they're having to account for all this cash, when there's over $10,000 in cash deposits, they now have to file all these forms for money controls with the Internal Revenue Service. And that's why they're charging a convenience fee to do that based on the number of, of dollars that they're having to handle in cash. The same thing with coins. if it's a laundromat, a car wash, things like that, where you're using quarters and stuff like that, that can, people that own vending machines, they're being charged a bunch of money just because they're handling loose change. And a bank physically has to have someone that double and triple checks the coin count, sends it off to the Federal Reserve. They have to ship stuff. They don't want to keep all this coin, in their vaults. So because of that, they charge extra fees for people that handle a lot of cash. So what I'm trying to get at is that it's okay if somebody owns a business that handles a lot of cash. We will never ask you to source the cash. We will not back it out of the deposits because it's part of their business operation, and you will be okay. Now, if it's a real estate guy and says, "Oh, I own a real estate company," and all of a sudden, look, I'm depositing, 100 grand in cash, they're going to start raising some red flags because it's not a part of their business. Now, if it's a landlord and he says, "Look, I can't trust this tenant because he bounces checks on me all the time, and I do actually collect cash from certain tenants," then that's perfectly fine. But we can't expect that if they own 8 properties and they're 3 units each, you got 24 different tenants that all 24 are going to be paying in cash. We're going to have a very, very difficult time believing that, because some people are going to pay in cashier's checks, money orders, regular checks, whatever it may be. Some people pay with Venmo, some people pay with Zelle. It's a faster way to get the money there. And then the borrowers and the landlords are happy because they see that nothing bounced, that the money's there instantly. So keep that stuff in mind, because that stuff does happen in real life. Okay. So we also offer a 1-year self-employed program. The reason we developed this program is because we've run into a lot of different situations where, for example, we have a bar that says, "Well, I'm a doctor, a medical doctor. I worked for Kaiser for the last 10 years. And now I decided to go off on my own and open up my own business. I'm still going to be a part of Kaiser, but now I'm going to be considered to be an independent contractor because Kaiser's going to refer patients to me because I'm a cardiologist, a specialist, and I'm going to be under contract with Kaiser." So now Kaiser is paying that doctor as a self-employed individual. So they went from being W-2 to self-employed. When that happens, the majority of the lenders will say, "Well, you have to be self-employed for 2 years and file 2 years of self-employed income tax returns in order for us to do the loan for you." For us, it's like, no, all you have to do is show that you've been self-employed for at least a year, for 12 months. If you went from being a wage earner and you're still in the same exact line of work, and now you became self-employed, we're okay with that as long as you could prove that you've been self-employed for 12 months. You give me a copy of the previous year's W-2s. We'll do a 4506C just for the W-2 transcript. We'll do a written verification of employment for your previous employer. And then we'll use your self-employed income, and you could use 12 months bank statements to qualify. This happens a lot for people that went from being 100% W-2 to all of a sudden becoming like an independent distributor for somebody. And now they're self-employed. They were making a ton of money as a W-2 employee. And now if they become independent, they can make even more. And now they don't have to pay any taxes. And now they can become a corporation of their own and expense things. And they end up making more money in the long run. So if you do that, we're okay with that. But we do require proof that the borrower was previously in the same line of work and they just went from being W-2 to being self-employed, and that they've been doing it for at least a year, and you'll be fine. What we ask for to prove self-employment in the last 12 months is a copy of their business license. If they went and opened up a corporation, articles of incorporation, or a letter from their accountant that states that, yeah, he used to be a wage earner and now he became self-employed as of March of 2022. He became an independent contractor. Now he's getting paid via 1099 at the end of the year, but it's the same exact stuff that he was doing before. So as long as that happens, you're perfectly fine and we could do the loan. Any questions before I keep going? As far as I'll be more than happy to share. Actually, Deshaun already has a copy of this presentation. I'm sure he could share it with you guys. As far as the matrix and the guidelines, I'll leave that up to Deshaun and David and stuff to figure out whether or not they want to share those, because a lot of those are internal guides. It's up to them if they want to share that with you guys. Okay, NSFs. I covered this a little bit earlier, and I wanted to emphasize how important it is when it comes to a bank statement loan. So here's a bar that can provide full income documentation, no tax returns, no W-2s, no pay stubs, nothing where you could verify their income. And now they're saying, I need you to trust me. Here's 12 months bank statements. You start going through their bank statements and you see that they're bouncing checks left and right. So here they have their credit's not that good. They can't provide full income documentation. And now they want you to use alternative income documentation to qualify them for a home, but they're bouncing checks on even items as small as $12, and there are things like that. That's going to raise a lot of red flags, because when somebody bounces a lot of checks, it shows proof that they cannot manage their finances. And if you can't manage your finances, then it's going to raise a lot of red flags, because if you're bouncing small items, when it comes to a mortgage, the tendency is that you're going to bounce a very large item or not pay it at all. If somebody has a perfect banking record and they have really good credit, it shows that not only do they take pride in their credit history, but they also take pride of the way they manage their finances. If someone's very sloppy, and you look at their credit and they have a bunch of late payments on their credit, they have a bunch of bounce checks on their bank statements, they have a lot of overdrafts and things like that, it shows a pattern that these people really cannot or do not care to manage their finances properly. And so for that reason, that could be grounds for a loan getting declined. So we do look at NSFs for the last year. We want to make sure that the borrower doesn't have a bunch of NSFs on their bank statements. If, for example, they have a client, and we see this often in construction, where you're a subcontractor and you're doing plumbing and heating and things like that on a project, the general contractor cuts you a check. Next thing you know, the general didn't get paid by the person who's running the job or whatever. And all of a sudden a check bounced. But the check that they gave you bounced. And then that triggered a chain of events where it forced a bunch of your checks to bounce to vendors that you paid, assuming that the check that was given to you was good. If something like that happens, and we could document the fact that somebody gave them a bad check, and that triggered a domino effect where it led to them bouncing checks, then with a letter of explanation and documentation to prove that somebody gave them a bad check, you could overcome NSFs or overdrafts with that. But if it's the borrower that had very little money in the account and they cut a check anyway, then that's where we start having a difficult time, because it shows that you cannot manage the finances, and they really look at that very, very closely. So return checks, as I mentioned, are considered separately, because if somebody gave you a bad check and that's what triggered the stuff, as far as the bad accounting on your account, then you might be okay. But we're going to need some very good explanations as to what happened. How are you going to prevent it in the future? What can you do to protect yourself or your employees so that this doesn't happen again? The underwriter will take all that into consideration. Now, excessive NSFs are highly scrutinized and may render a loan to be ineligible. We look at the number 6 now. Up to 6 NSFs or overdrafts in the last 12 months is acceptable. If it goes over that, the loan could get declined. If it happened in the last 3 months, it's going to raise a red flag with the underwriter, and the underwriter is going to say, what the heck happened and why did it happen, so soon? If something happened a year ago and it's on the very last bank statement that you gave me, they're going to be less concerned about that than something that happened most recently. So just be aware of that. And if there's anything that goes over 6, it's going to require not only the underwriter to sign it off, but upper management to sign it off, because that may render a loan unsellable. And an investor may not want to take a risk on that bank statement loan, saying this person can't manage any of their finances and they're bouncing checks left and right. So that income that you came up with is not real income, because if they had $15,000 a month in income, they would not be bouncing $200 checks. They would be moving part of that 15 grand a month to leave a cushion in their bank account to make sure that they never bounce any checks. And that's why the ending balances on bank statement loans is very, very important, because that tells you exactly the way the borrowers are managing their finances. How the bank statements are calculated are very, very simple. We look at the raw deposits of what's coming into the bank account. We back out any type of refund, any type of interbank transfer. That stuff is considered to be a non-business related deposit. What I mean by that is if a bar is moving money from their savings account into their checking account, that is not a deposit. If they go to Home Depot and they buy a toilet seat cover for $56 and then they say, "Ooh, I bought the wrong size." They go back to Home Depot and get a refund for that. And you see the refund, that gets counted when you look at their bank statements. It's being counted as a credit back into their account. But that is not considered to be a business deposit. The only business deposits that we look at are the ones where you went to a bank teller and you made a physical deposit. You went to an ATM machine and made a physical deposit. Or you got bank wires from vendors that you do business with, or they did an ACH transfer to you for people that you do business with. Or you have a merchant account, and every 3 to 4 days, that merchant account is depositing money into your account because you accept Visa, MasterCard, American Express, and things like that. Those are true legitimate business deposits. Anything where you're moving money from one account to the other and things like that, those are not deposits. Anything where you're returning items for credits, those are not considered to be deposits. So those are the only items that would be backed out of a bank statement loan. And then you get credit for the adjusted deposits. They add up and they tally up the last 12 months. And then you apply the expense factor based on the type of business that they're in. For example, the borrower is a dentist. He deposits about $2,271,000 in the last 12 months. So he owns 100% of the company. It's a corporation, but he has about 17 employees. So he has more than 10 employees and he's providing a service, right? So his expense factor is 60%. So after it's all said and done, his monthly net income for the last 12 months is about $75,000 a month. And that is the number that goes on the 1003. And that's the number that we use to qualify the borrower. So in the event that the loan closes, for example, in September, what we do is we continue to add bank statements. So we constantly update them to be within the last 30 days. So if he closes in early September, we should have at least July's bank statement in there for 2023, and we drop the bank statement for July of 2022. So our income is always fresh and it's always up to date for the last 12 months. The max we allow it to go is about 45 days. So if you close it early September, the August statement is not ready yet to be reconciled. So we'll go with the July of 2023 bank statement. Once we add up all of those deposits and we back out all the non-business related deposits, that's how we derive at their income. We apply the assumed expense factor, which I showed you on the other page. And then that tells us what the monthly net income is that's going to be allowed to be used. Now, we kept referring to the matrix in the presentation. The reason we refer to the matrix is because you have to learn how to credit grade your borrowers. What I mean by credit grading is that if you have a borrower that has absolutely perfect everything, perfect credit, their LTV is nice and low, they're doing a primary residence, They have a ton of money in the bank. They have perfect reserves. You're like, man, this person could be Fannie Mae. The only reason they're not Fannie Mae is because they can't prove their income. So they're using bank statements in lieu of W-2s or tax returns. Then that borrower that's very close to Fannie Mae, that would be considered someone to be a select borrower. Select is the best priced loan programs that are offered out there. It's for people that have very good FICO scores. It's for people that, when you look at the housing history, have a perfect housing history. They've never been late on a mortgage in the last 2 years. When you look at their credit, they have nothing wrong with their credit in the last 4 years. So no bankruptcies, no foreclosures, no short sales, no deed in lieu of foreclosure, like nothing. Their credit is really, really good. If someone fits that criteria, then you could do up to a 90% LTV purchase money loan. You go up to 90% LTV on a rate and term. And if you're trying to do a cash out, it says reduce it by 10%. So in other words, the max LTV on a cash out is 80% under that loan program. They go all the way up to $1 million and up to a minimum 700 FICO score. So the rate on something like that is going to be in the low 7% range, which is very, very close to where Fannie Mae is, considering the fact that you have to add in all these LLPAs and layers of risk when you're doing a Fannie or Freddie Mac loan. If someone doesn't quite fit that criteria, or you need higher loan amounts, higher than $2 million, then you go down to the A+. A+ means that the borrower still meets a lot of the strict criteria that we have, but the guidelines are a little bit more flexible. Now, instead of 0 times 30 in the last 2 years on their mortgage, if they had a mortgage late that was 18 months ago during COVID, oh, I missed a payment, whatever it may be, then you may not be Mr. Perfect under Select, but you're still considered to be an A+ because you've been clean for the last 2 years. Credit events, as long as they haven't had a bankruptcy, foreclosure, or anything else in the last 3 years, they're considered to be an A+. On an A+, you could do non-owner occupied properties all the way up to 85%. You could do second homes to 85, condos to 85, but you could do a primary purchase all the way up to 90%. The loan amounts go all the way up to $4 million for the higher FICO borrowers. Of course, the LTVs on the super jumbos tend to get cut to below 80% LTV, so also be aware of that. But the guidelines are a lot more flexible. Also under an A+, they start allowing some different types of loans. We allow, of course, bank statement loans. We allow 1-year self-employed borrowers, which we just discussed. They also allow asset utilization. Asset utilization means that if a borrower is having a hard time qualifying full doc and their debt ratio is like 53%, and you're like, man, their debt ratio is a little bit too high, I need to be under 50, but they have $2 million in retirement accounts and that they've stashed away. You're able to take that $2 million and deplete that $2 million and give it to them as additional income. And you're able to utilize those assets. That's why it's called asset utilization, where if you give the borrower, for example, a 5/6 ARM, a 5-year fix, in other words, you're able to take that $2 million divided by 60 months, and that's the additional income that the borrower will get credit for. So you take that $2 million and you multiply that, divide that, by 60, the borrower gets credit for another $33,000 a month in income, where their tax returns may only show $100,000, but you're trying to give them a $2 million house. You're like, they don't make enough income. Now you could deplete some of their assets and utilize that and blend it together with your full donk income to qualify. Or if the borrower, for example, is retired altogether and their only source of income is their assets, you could take all of those assets and do the same thing, and you only use assets to qualify. We also allow you to do a VOE only program. The borrower must work for a large company where it could be verified, and it's a public type of company where it's very well known in the industry. It cannot be where, oh, I work for my mom and dad and I'm going to do a VOE only program where they can manipulate a VOE. The VOE must be processed at corporate internally. So a loan officer can't do their own VOE. We prefer for the VOEs to come directly from the work number or Equifax or some other company that does an independent verification. And whatever income is on the VOE, that's what you use to qualify, whether it be the hourly salary, bonuses, overtime, all of that stuff will be averaged out. And then that's the income that you're able to utilize. We also allow 1099 only programs. So if the borrower is self-employed and they're 1099, you ask for 2 years 1099s, take the 2 years 1099s, add them together, divide it by 24 months, and that becomes their monthly income. You get 3 months bank statements to support the 1099s. So if the bar is showing, $300,000 a year average on 1099s, that's about $25,000 a month in income. You ask for 3 months bank statements, and we look at the bank statements to make sure they're depositing on the average of 25 grand plus or minus 10%. We give them a variance. If they're depositing the 25,000 a month, you put that on the Title III and they get credit for that. And that's how a 1099 loan works. We also allow condo hotels, which are very popular in Florida and in Vegas. A lot of those high-rise condos in Las Vegas, you're able to rent right back to the casinos. MGM Signature, Palms Place. There's several different types of condo hotels that you could do along the Las Vegas Strip, which are pretty popular. And you're able to use the rental pool, the statistics that comes directly from the rental office. They could tell you a projection of what the projected rental income is going to be. And instead of using it off a 1007 rent survey for a long-term tenant, you're able to utilize the rental income that's coming directly from the rental office. And last but not least is our I-10 loans. We go all the way up to 85% on an I-10 borrower. It does require at least a 660 FICO. We go up to $1.5 million loan amounts. You can either do full doc or 12-month bank statements if they're self-employed. When we're asking for full doc, we ask for 2 years tax returns. We make sure that the I-10 number is what was used to file the tax returns. We will not ask you for W-2s, and we will not ask you for pay stubs, because we know that in order for a borrower to work in the United States, they cannot work with an I-10 number. They can only work with a social security number. So if you ask for W-2s or if you ask for pay stubs, the likelihood of a fake social security number showing up on both of those documents is going to be very, very high. And the last thing we want to see is a fake social, because that would show that the borrower has stolen somebody else's identity in order to work in the US, and the loan would be declined. So that's why we will only ask you for the tax returns. We verify the tax returns with the IRS with federal income tax transcripts. And we do a written verification of employment to get the borrower's current rate of pay from their employer. And that is what's used to qualify the borrower. So any questions that you guys have?
There's a few, Gil, in the chat box. Can you see the chat box by chance?
Yeah, hold on, let me see.
And I have a question.
Yeah, I'm the one that had that question. What if they don't have a credit score? They have credit, but they haven't used their credit cards, and so it's not showing credit with an I-10.
We do not do any loans that do not have FICO scores. The borrowers must have 3 FICO scores.
Okay, thank you.
And have to have trade lines too.
They must have at least 3 trade lines that are open and active for at least 12 months. If they don't have 3 trade lines open and active for 12 months, then we ask for
Usually
1 trade
11,
line
12.
that's open and active for at least 24 months. And then you could build 2 non-traditional trade lines. So if they're renting, for example, through an apartment building, and there's a professional property manager managing the property, then you could get us a verification of rents through the property management company, and that will count as a trade line. If they have a kid that's attending preschool, like KinderCare or something, or they have an account with like Huracao, or they have something that's not reporting on their credit, you could also build non-traditional trade lines utilizing that. Their cell phone bill, their auto insurance, utility bills, all of that stuff that could be verified with canceled checks or you could put on a credit supplement, could be utilized as an additional trade line.
Hey,
What's
Gil, can you just
I was
talk a little
gonna-
bit about this?
what-
Go
I'm
ahead.
sorry, talk a little bit about what?
If a social security comes out on the I-10 credit report,
Okay,
like an
so
additional social security number.
so when you pull credit utilizing an ITIN number, and you go to aliases, if you see a bunch of other numbers on there, then that means that the likelihood is that this person has used a fake social either to work or to try to get credit. The way you overcome that on an ITIN loan is that we ask for a copy of the original letter that was issued by the IRS to the borrower when they first got their ITIN number. So let's pretend that that letter that they got from the IRS shows January of 2017. That's what the IRS letter says. We now look at the credit report and we see that the very first trade line that was ever opened up on his credit was March of 2017. So that was 2 months after the IRS gave him his ITIN number. So because it was after, then we're going to say the borrower has only used his ITIN number to obtain credit because he had no reason to lie and use another social because the guy already had his ITIN number. So that other stuff is just being reported in error and we just ignore it. Now, if the opposite happened and you pull his credit and he didn't get an ITIN until January of 2017, but all of a sudden you see credit on there going back to 2009. And you see accounts with La Curacao and other people, and they're open and they're active, and you're still using them. And you see fake socials on the credit report, the loan's going to get declined because that person used the fake social to open up that account and he's still using it. So that's identity theft. So does that make sense as to how they look at that?
It does to me. I just want to make a question one so everybody understood that part.
Okay. So can an ITIN loan, can you use alternative? What do you mean by alternative? And Angelica, what do you mean by that? Can you use alternative?
You already answered that question when you said that if they had at least one trade line with the on the credit report within 19 and 24 months, that you can
Okay.
actually build it up. So
Cool.
thank you for
Okay.
answering.
Yeah. Okay. Can ITIN loan have a non-ITIN borrower U.S. citizen? Yes. So if one borrower, let's say a spouse is a U.S. citizen and the husband is an ITIN borrower, yes, you could do that. And by the way, if the spouse has the trade lines and you're pulling a joint credit report, one with an ITIN, the other one with a normal social, if jointly, because they're married, they meet the 3 trade line requirement, that's it. You're fine. You must have 3 bureaus, 3 scores reporting. Yep. Okay. At times only 2 report. If on an I-10 loan, you're 100% right. When you pull credit, normally you do only get 2 FICO scores. There's one bureau in particular, and it's normally Experian. Actually, I think it's Experian or TransUnion. One of them doesn't report FICO scores for I-10 borrowers. We only do require two FICO scores for any loan. We just can't do a loan that has no FICO scores. So you will be okay, Ariana. Any other questions before we break?
Quick question, Gil, on your asset depletion,
Mhm.
will you, is there an expense ratio that needs to be taken into account or whatever my ending balance is divided by 61?
Actually, there's a little worksheet that we use when you're trying to do an asset depletion loan. There's 2. One
Okay.
that has no DTI, and another one we're just trying to utilize the assets to boost your income that
Gotcha.
you are to report to the IRS.
Okay.
So when you're just using assets, that loan does not have a DTI. And what you're doing instead is you're saying, look, I have $2 million in the bank. I'm applying for a $400,000 loan. If I really wanted to, I could buy this house in cash. So what they do is they say, okay, we're going to take that $2 million and we're going to subtract the entire loan amount from that $2 million. In addition to that, we're going to back out all of the closing costs for this new house. And then we're going to make sure that there's enough money and assets left over to cover all of your bills for the next 5 years. So they'll look at car payments, credit card payments, anything that's on the credit report. And once they add all that stuff up, if you have more than enough assets to cover all of those things, the loan is approved. Which
Gotcha.
someone that has $2 million buying a $400,000 house, there should be no way in hell that they could never qualify. They will qualify, even if they're buying a $1 million house, they will qualify.
Understood. So there's no expense ratio. You're just taking into
Correct.
the bill for the next 5 years on
Yeah,
top.
yeah. Exactly. Unless you're using the assets when you're blending it together with your full doc income, then they'll just do a normal debt ratio calculation.
Understood. Thank you.
Sure.
Hey, Gail, this is Cardigan. So verification rate, I know this is some of the issues we run through when we do items.
Okay. What's the issue?
What is it? What is the stuff that you guys require and you guys accept, and what don't you not accept?
Okay. What we do accept is we prefer that if the bar is living in an apartment building, there's normally a professional property management company. We will accept a VOR only when it's a professional property management company. If they're renting from an individual, it becomes more difficult because you can't do a VOR from a private party. So instead, what we will ask for is 12 months cancel checks. And if you get the 12 months canceled checks, then you have your housing history and you're fine. That's how we get around that.
Thank you.
Mm-hmm. Any other questions? What if they pay the rent in cash? Then they're screwed, Anna. If they pay the rent in cash, there's no way you can verify that. There's no way you could get the canceled checks, and there is no way that you could get a verification of rent.
Well,
So
okay.
in that point, that loan would be declined.
What if I can show every month out of the bank statement the same amount of money being debited out of the account?
That might work if he's showing that he's withdrawing, let's say $2,000 a month every single month, and that's his rent, and he pays the landlord in cash because the landlord won't accept a check for the guy. I'm sure we can make an exception for that. But what I mean by cash is that, the rent might be all over the place and you can't see a pattern of it coming out on a specific bank statement and things like that. But in that case, you would have to provide 12 months bank statements to show, look, this is where he's paying the rent. Any other questions? Cool. I'll turn it over to you then. Dershawn, are you there?
Thank you, Gail. You
Sure I
rock,
am.
bro.
Does anyone have any other questions for Gil? Gil, that was the end of the presentation, correct?
Correct.
Okay, beautiful. Yes, Maria, I will get that over to you before end of business day. I'll get that over to the full team. All right, well, I am super appreciative to Gil for taking almost an hour and 40 minutes of your day. That was amazing information. Thank you for going into depth. If anyone else have any questions, feel free to relay that information over to myself. My name is Darshan. And either I'll get the information if I don't personally have it from Gil, or between myself, Ruben, Gil, Gil, Tanya, and David Tran will get that answer question for you. But minus that, thank you so much, Gil, for taking the time, and we look forward to doing another training, maybe in the future, maybe doing a DSCR with you.
Cool. Absolutely. My pleasure, guys. Have a good one.
All right, take care. Bye-bye.
Thank you. Thank you.